Hello, this is Professor Zhang. In today's lecture, we're going to talk about Chapter 4, Adjustments. So, why adjustments needed for the financial statements? If you why adjustment needed? If you recall in Chapter 2 and then Chapter 3, so the accounting system are designed to record most recurring daily transactions. So if you recall how the process starts, we started out to analyzing a transaction. A transaction happened normally when it's involved cash. So with cash in or when there's a cash out. So we analyze the transaction. If the transaction had a minimum of two effects to the basic accounting equation, then we will record it, right? So we also learn from chapter 3, a lot of time cash is not always received or paid at the same time when the company earns the revenue or incurs expense. If you recall in the chapter 3, we talk about these cases, right? A lot of time you have to either record the revenue first before you receive the cash, or you have to record you received cash first before you can actually to record your revenue, right? That's a lot of case. So that's why we need to book those adjustments to the accounting record at the end of accounting period to making sure all of these assets, liabilities, revenues, expense are recorded properly. So remember in the what type of adjustment that were needed in the income statements. Because remember, according to the revenue recognition principle, revenue is supposed to be recorded when earned. So the earning process has to finish before you can record a revenue, right? So when we record cash or before the revenue can earned, what do we record? If you remember, we recorded cash because we received cash. So we don't credit revenue because we haven't finished the revenue. That case, the example that we used was a gift card, right? Was a gift card case. And then on the credit side, we don't credit revenue because we haven't finished the revenue. These are just gift card. Gift card is just a promise to your customer, right? So if that's the case, we normally record unearned revenue because we didn't record revenue. That's why we need adjustment. When the earning process finish, we need adjust it so that we can record revenue when it's earned. Expenses are recorded in the same period as the revenue to which they related. We also went through a lot of cases, right? We don't necessarily have to pay the cash at the time when we incur the revenue. One particular case, we sometimes have to even prepay the expense before they actually incurred. If you recall, we use example for the rent, right? We prepay the rent and we call these prepaid rent as an asset. They're not expense. So we have to adjust them into the expense when the the rent actually incurred. So that's the adjustment that we need to the income statements. So in the balance sheet, we also need adjustment. The adjustment that we needed to making sure the assets are reported at amount representing the economic benefit that remains at the end of period. What does this mean? A lot of time we have accounts receivable, right? So initially we had this transaction saying that okay, we earn the revenue, but we don't necessarily receive the cash. So we have accounts receivable, right? That's a transaction. When cash actually pays out, we have to adjust it, making sure that we record the cash and decrease the accounts receivable. Liability are recorded at amount owed at the end of period. one example I already used when we're talking about we receive the cash before the revenue process, before we earn the revenue. So we record unearned revenue. Unearned revenue is a liability, right? At the end of period, when the earning process is finished, those unearned liability is no longer liability because they already fulfilled the promise. So we have to make adjustment for it. So there are two type of adjustment in accounting, in the in income statement and balance sheet. So the first type of adjustment we call deferral adjustment. By its name, deferral meaning we postpone it, right? So expense or revenue has been deferred if we have postponed reporting it on the income statement until a later period. So a lot of time we have to we receive the cash or we pay disperse the cash before revenue is earned, before expense is earned. So that we're deferring reporting the revenue and the expense. So when it's actually happened, we have to make adjustment. That's what we call deferring adjustment. Here's example, right? That's example we used in chapter 3. So we pay the cash for rent in advance in September 1st. And that cash that we paid in advance for rent is asset. It's a prepaid rent, right? And then for the months pass by until the end of September, September 30th, we need adjustment because you already, whatever you have banked for it, when you put the cash, prepaid cash for rent, we call banking it, right? You're banking this expense. So at the end of the month, this month's rent is already used, right? You no longer have this banking that you put it up for your rent. That's when we need another adjustment for it. And then here's another example. So cash received for game download in advance. So you received cash before you actually earn the revenue because you haven't delivered your product yet. So, and then by the end of month, your product delivered. You deliver the game and downloads. That's when also we need another adjustment to making sure when earning process finish, we need to record the revenue. So this type of adjustment we call deferral adjustment. The deferral adjustment are used to decrease the balance account amount and increase the corresponding income statement accounts. So it's always, remember, when we have to adjust the unearned revenue. Unearned revenue, you have to decrease the unearned revenue, increase the revenue, which is income statement account. So another one was the prepaid rent, right? Prepaid rent is a balance sheet account. So when we used up the rent, we have to decrease prepaid rent and then increase what? Increase the expense statement account, which is expense, the rent expense. So it's always decrease balance sheet account and increase the expense statement account. That's a deferral adjustment. And each deferral adjustment always involved one asset account and one expense account, or one liability account, one revenue account. Okay. So here's the deferral adjustment. Some of the examples. On the liability side of it, you have unearned revenue, right? That's your liability. And then you have a sales revenue or service revenue. That's your income statement account. So on the asset and expense side of it, you have a balance sheet. Remember, when you bought the supply, before you use the supply, you put supply as an asset. So you debit supply. So that's your asset. And then once you used up the supply, you need a deferral adjustment to making sure these supply is already used up. So you have to put it into the expense account. So it's another income statement account. That's a supply expense. Prepaid rent, we use this example already. When you prepaid is asset, so when you used up the rent, then it becomes a rent expense. Same way as a prepaid insurance, right? A prepaid insurance is your balance asset, And then when you use a month pass by, and then it becomes insurance expense. There's another type of accrual adjustment we call accrual adjustment. Accrual adjustment means that when company has earned revenue or incurred expense in the current period, but has not yet recorded because we haven't received the cash or we haven't paid until later. Okay, here's example, right? So in September, from September through, September 30th, and you incurred income tax. So because in this month you made some earning, you're supposed to have to you already incur your income tax, right? You have to allocate this income tax monthly. Every month with your earning, you're supposed to have income tax, but you don't normally pay this income tax until probably the end of the year. So then each month you need an adjustment to record your income tax. December 31st, that's when you actually to pay the cash. So at each month's end, you have to accrue your income tax. Okay. So another one was that, in September 1st, in the month of September, you earn your revenue from promotional service, but you don't receive your cash until the end of year. So in that case, by the September 30th, your revenue earning for this month is already end. So you're supposed to need another adjustment to record the revenue. And then you don't have a cash because you're not going to receive cash until the end of the year. That's according to the revenue recognition principle, because you have to record the revenue when earning is already finished. So in the accrual adjustment, I use to record revenue and expense when they occur, but prior to receiving or paying cash, right? And then each accrual adjustment, same way, you always have one asset and one revenue account, or one liability and one expense account. So here's an example. In the balance sheet, you always have these interest receivable. And then you have interest revenue on the other side. That's your income statements. Remember, the transaction always has to be dual entry, because in the interest, if you loan to a vendor or to a company, you don't know, they don't pay you interest every month. They may only pay you quarterly. They pay your interest quarterly, or they pay your interest semi-annually, or sometimes even they don't pay you until a year. But you have to recognize your interest revenue every month, right? So that's why it's a revenue recognition principle. So you have to recognize when months pass by, you have to accrue your revenue for interest receivable and interest revenue. Rent is the same way, right? Sometimes you don't receive your rent until a quarter later or until a year later, but every month pass by, you're supposed to recognize your rent revenue. On the other type of it is the liability side of it. So that's just the other way around. So if you have to pay income tax, right? You don't have to pay income tax every month, but you do pay them quarterly. So every month pass by, you have to record your income tax expense when it's occurred, according to the matching principle, right? Your expense has to be recorded as they incurred and relates to the revenue you are making. So same way as a wage payable, you sometimes don't pay your wage until a specific date. And when your month's closed, you have to recognize your wage expense. So these are type of the accrual adjustment. So here's example. Let's go through some examples. Okay, making required adjustment. This is the circle we used for our chapter 1 and chapter 2, right? We started out as analyzing a transaction, right? Then to record transaction, right? Record the adjusting transaction. Then we do a summary and then prepare trial balance. Then finally we have to report financial statements. But adjustments are not made on daily basis because it's very difficult to recognize, let's say, rent day by day, right? So months is already difficult enough. You can't just really like all salary expense. You can't just recognize everybody's salary expense every day. We normally do it at each of the at the end of each accounting period. So some companies do it quarterly, some companies do it monthly. So same way, we have to go through the whole process, analyzing it first. At the period ends, we have to determine the necessary adjustment to make the accounting recording. So we want to say, okay, where are we? All of these unadjusted balance, right? Do we need adjustment or not? If we do need adjustment, then where do we need adjustment to be? So this is a process we have to go through. If you record the whole accounting process, you started out by the daily transaction, right? So you analyze the transaction. If the transaction involves cash in and out, especially, right? Then you have to make sure they have at least two effects to the basic accounting equation, and then you record those transactions. After you record your transaction, you prepare what? A trial balance. It's called unadjusted trial balance. Now you go through all of these trial balance at the end of the month or end of accounting period or end of quarter. So you kind of try to making sure, see, are there adjustment needed, right? So you go through the trial balance account. Started out from the beginning. Okay, the accounts receivable. You want to making sure like, okay, so in accounts receivable, is this the balance supposed to be at the 500? Did we have another, a revenue just earned and haven't received the cash yet? So do we need to do any adjustment to this accounts receivable? And same way with the supplies, right? Supplies, yes, we bought it at 600. Now, how much of the supply has already been used, meaning expensed, right? If that's the case, we may have to reduce the supply and move them over to the expense account. Prepaid rent. So we prepaid this rent. Now, 1 month passed by. How much of this prepaid rent has already been used? So we have to adjust this prepaid account. So, and then in the equipment side of it, we'll talk about this later. As we said, every item you capitalize it, you're supposed to depreciate it. So once you depreciate, there's a contra balance sheet account called accumulated depreciation expense. So we want to making sure that this account we put up the depreciation expense either monthly or quarterly, right? So you kind of go through each account to making sure all of these accrual adjustments. So if we need, are there any accrual adjustment that I need to make? So are there any deferral adjustment that I need? So you go through analyzing it first. Once you analyze it, you say like, okay, this I need adjustment. The first item we talked about is the supply, right? You already determined there are quite a few. Through your analysis, there's some transactions, some accounts that you need to make adjustment. Right. The first one, let's go through these examples. First one, supplies used during the period. So of $600 supply that you bought, at the end of month, September, or you only have 250 remain on hand. So the rest of it, you already used it. So once you use it, what do you call those? We call those supply expense. So if that's the case, we need to move the supply, whatever the balance. We want to make the balance from 600 to 250. So we have to move. Okay, so where are we now? So now in the unadjusted balance, we still have $600 there. How much adjustment do we need? because the balance is only 250. So we need to make adjustment of 350. This 350 adjustment, we need to take down the supplies, right? And we have to increase the expense amount by 350 because all of these supply already expensed. So this is where it need to be. So the supply balance now should be only at $250, and we should have a supply expense at $350. So now we have to make this transaction. So the transaction would be we reduce the supply from asset. So by $350. You see a negative, so you have to reduce this by $350. And then you have to increase your expense by $350 because the expense is part of your equity, and part of your equity, when it's increased to your equity amount, it's the right hand side of it, so it's also a negative here. So that's your journal entry would look like. You debit supplier expense because that's the negative to your equity. So your equity is on your right hand side of it. So increase to your right hand side is credit. So decrease to your right hand side is debit. So you debit supply expense and you credit the supply because credit is decreased to your asset account. That's what we call what? Deferral adjustment. Okay, this is how the T account looks like it. So, and then what's the financial statement effects? The financial statement effects would be this $350 adjustment to your balance sheet, right? Because your balance sheet now, the balance of your asset reduced by $350, it became $250. So the income statement, you should have an increase of $350 to your expense. Second one, the rent benefit expires during the period. So you 3 months of rent, we prepaid the 3 months of rent, right? So if you look at this is $2,400. So we prepaid $7,200. That's a 3 months worth of rent we prepaid. When we prepay them, what do we call them? We call prepaid rent, and prepaid rent is part of your asset. So by the end of the September, September 30th, so this portion of the rent is already, the benefit is already exhausted. So, and then you have to make adjustment at this end of accounting period to record the $2,400 of the rent as a rent expense. So because that 2/3 of it is still there. So your balance of prepaid account is no longer $7,200. Now your balance of the prepaid rent should only be $4,800. So now you decrease your prepaid rent by $2,400. This is 1 month's worth of your rent for September. And then you increase your rent expense by $2,400 because your rent expense has already incurred. So the transaction would be decrease of asset, which is in your left hand side of it. So that's what? That should be a credit, right? So the increase to your rent expense on your equity, so that should be debit. Now your accounting transaction looks like debit rent expense, credit prepaid rent. So the idea here is just saying you have to reduce your prepaid asset and increase your rent expense. Example C, depreciation is recorded for the use of equity. So we will talk a lot more about the capitalization and depreciation later in the chapter. But here, so when you bought a computer equipment, right? So the computer equipment we're expected that can last for 2 years. So you can't really expense them right away. You have to what we call capitalize it. So now you already use it for a month. So once you use it for a month, then you should have a 1 month's worth of expense, right? So depreciation is the process of allocating the cost of buildings, vehicles, and equipment to the accounting period in which they are used. In other words, depreciation is the benefit of this whole capital item, right? We have to record them to the expense as they exhaust their benefit. So there is a contra asset account that's offsetting or reduction of another account. That's called accumulated depreciation. Accumulated depreciation is a contra asset account. So it looks like this in the balance sheet. So you have equipment, that's your capital asset account. Then underneath it, you have this accumulated depreciation account. This accumulated depreciation account is a contra asset account. This is a reduction to your asset account. So then you have a net equipment, what we call book balance, right? That's the adjustment that you need to make. So in here, in your asset book, you should have accumulated depreciation account. And then in your equity here, because you have a depreciation expense, so you increase in your depreciation expense of $400, and you have not decrease, in also another increase to your accumulated depreciation account. Don't be confused with these negative sign. That just means in here why it's negative, because it's a contra asset account, the account called reduction to your asset. That's why it's negative. So any contra asset account or reduction of my asset account should be credit, right? Any increase, this expense is a reduction to my equity account. So the increase of expense, which is a reduction of my equity account, you debited. Right? So what is really a depreciation expense? We will talk this in much more detail later. Now let's just briefly go through it. So in your balance sheet, you always have this accumulated depreciation account. And then in your income statement, you should always have this depreciation expense. And accumulated depreciation, it should be the contra asset account to your asset. And then depreciation expense is your income statement account. We will talk this in much more details later. Amortization is recorded for use of software, because any intangible asset, we have to amortize it. So once a software that we developed, and then software that we develop we're supposed to use for 3 years, then you have to capitalize it, right? Once capitalize it, then you have to amortize them, same way as the depreciation expense, right? If you buy your useful life, if we estimated this is going to have 3 years of useful life, and then if now we already use it for 1 month, then you have to record all the monthly amortization expense. It's exactly the same concept for the depreciation expense, right? You take the total asset, then you divide it by 3 years. And then you divide it by 12 months, because every month you want to record this amortization expense. Exactly the same concept as the depreciation expense. So now another deferral adjustment. The example that we use in chapter 3 for gift card, remember? So when customer come into your store, they bought a gift card. The gift card is not the time when they bought a gift card, they give you cash, they bought a gift card. Gift card is just your promise to your customer, and it's not revenue yet because you haven't fulfilled your promise until your customer comes in to redeem the gift card. You cannot record your revenue. Now, so this company redeemed $100 of gift card that customer used to pay for the game downloads. So now when they bought the gift card, what do they record? If you remember from the chapter 3, we record what? Cash, and another account is what? Unearned revenue. Unearned revenue is a liability account. Now they redeem this $100. So your unearned revenue should be reduced because you no longer have the obligation. You already fulfilled your promise. And then your revenue account should be increased. So you should have a revenue increased and reduced of unearned revenue. Again, it's according to the revenue recognition principle. So revenue earned but not yet recorded. What does this mean? So this company, Sonic Gateway, provided 2,500 of promotional service to other app developer in September, with payment to be received in October. So you already provided this service to other app developer in September. The words provided meaning you already finished your earning process. So in that case, according to the revenue recognition principle, we should record our revenue. And then because you have not received your cash yet, so you have to accrue for it. So the accrual would be the accounts receivable increase because now the customer is owing to you. You have the right to collect $2,500 from your customer. At the same time, you already earned your revenue. So that's the accrual adjustment that we need to make. And then another accrual adjustment, wage expense incurred but not yet recorded. So we don't normally pay wages at end of a month. Sometimes, you have to pay it early. Sometimes you pay it later. So in this case, Sonic Gateway owes $1,200 of wages to an employee for work done in the last 4 days of September. Last 4 days of September, right? So if our accounting period closed at September 30th, but you don't pay until maybe mid-October. So there are 4 days of the wages that you need to accrue for it because that expense is already incurred according to the matching principle, if you remember. So in here you have a liability, which means you have an obligation to pay to your employee for $1,200. And then in your equity section, you should have a salary wage expense because that 4 days already passed, which means your expense is already incurred. So if you look at the accounting transaction, you should have salary wage expense and then you have a wage salary payable. Interest expense incurred but not yet recorded. Very same concept as the wage expense, right? So Sonic Gateway has not paid or recorded $100 interest that it owes for this month on its note payable. So in every month, you don't necessarily pay your interest monthly, but at the end of month, you should record your monthly interest expense according to the matching principle, right? So same concept. You should increase your interest expense because that interest expense is already incurred, and then because you're not has yet paid, so you should increase your liability account for interest payable of $100. So that's your accounting transaction for the accrual adjustment. So income tax incurred but not yet recorded. Exactly the same concept again as the interest expense accrual adjustment. So here we do a calculation first, right? So unadjusted balance and then total expenses. That's from your trial balance. Through your trial balance, and then calculated all of the expense. Then you say you have this expense of income of $1,000, and you estimated the company supposed to pay 20% of income tax. So you get your monthly income tax for $200. That's your just estimated amount. Remember, one of the shortcomings of the income statement, they don't always to be the exact number. A lot of time, because we have to record your revenue or recognize your expense as they incurred according to the matching principle, we have to use estimate. This is the case that we have to use estimate. So we estimated our tax rate at 20%, right? So now the income tax is $200. So in here, you should record your income tax expense of $200 and increase your liability account of $200. Okay, that's the accounting entry. So adjusting journal entries never involves cash. When it involves cash, these are just daily recurring transactions, right? When it's adjustment, they don't involve cash, right? Adjusting entries always include one balance sheet account, one income statement account. Because why is that? Adjusting entry is try to making sure that we recognize revenue when the earning process is finished. So when you recognize your revenue is part of your expense, part of your income statements, right? And then we also need record according to the matching principle. We always need to record the expense as they are incurred, and that's also expense is part of your income statement. But on the other side, because there's no cash involved, so you either have a liability account, decrease of liability account, or increase of your asset account. Okay, here's the examples that we had to go through. So remember the unadjusted trial balance. You have this accounts receivable. You went through all of these accounts to making sure which account that we need made adjustment. Now you have to after you made all of adjustment, now you run another trial balance. It's called adjusted trial balance. So that's correspond to a T account if you still use T account. After you prepare your adjusted trial balance, you now can prepare your financial statements. So if you have adjusted trial balance, again nowadays everything come out of the computer software, right? So you run a adjusted trial balance. You have adjusted trial balance. Now you can prepare your financial statements. Remember the sequence of the financial statements. We always need to prepare income statement first. So on the bottom portion of this, everything is already here. You basically transfer everything on the bottom and into income statements. Right? So income statements. And after you made your income statement, what's the next item you should prepare? It should be retained earning, right? So you have to do the retained earning. Retained earning always started out by the beginning balance because you just started your company September 1st. So you don't have any beginning balance. The beginning balance is 0. And you add the net income for this month and subtract any dividend that you paid, because in this case you don't have any dividend, so that's your retained earning balance. Once you have a retained earning balance, the next financial statement you can prepare is what? It should be your balance sheet. So balance sheet is basically every account on the top, you move it over here. So in the balance sheet, we also have to categorize them. If it's current asset and then current liability, right? Everything that is liquid that you can turn into cash, that's your current asset, right? Most liquid should list it first. One of the students asked me the question, should there be a sequence? Normally they should list it according to its liquidity. So cash is should always list it first, should always on the top. The next item, and it should normally always the accounts receivable. So in the current liability, again, the most current liability is everything you have to pay within a year. So accounts payable should always list it first. And then you have the equity section. Equity section, you have a common stock here, and then retained earning you just prepared from the retained earning statements. So once you have all of that, current asset, current liability, and then the next portion is your capital asset, right? So in your capital asset, remember those contra asset account, accumulated depreciation account, and then you have your net balance. Same way for the amortization, accumulated amortization. Then you have your net balance, and then retained earnings is what we prepared. So closing process. What is the closing process? Closing process is basically you kind of like reset your accounting system to be ready for the next accounting period. That just happens normally at the end of the year. So closing your temporary account. So it started again. They analyze the transaction. You prepare your journal entries and post to your account. Then you prepare your unadjusted trial balance. So by analyzing the unadjusted trial balance, you want to prepare this adjusting journal entries, right? So they either do it normally. The blue sign means they do it monthly. The orange sign means these are daily, because these are the daily journal entries, right? So the blue signs, you do it every month. And then you prepare adjusted trial balance. After the adjusted trial balance, then you do you prepare financial statements. We just went through that. So now, when the year closes, at the end of a year, what do? You prepare post-closing trial balance. And then you prepare the closing trial balance. You posted everything into the account. So what is this prepare this journal entry? What is this posting year-end closing means? It basically means you transfer your net income and dividends to retained earnings. So that you can establish a zero balance in all income and statements and dividend account. Basically, in other words, you have this income statements to reset to zero and start it over next year. So, and then all of this temporary account, the revenue account, expense account, and dividend account, all of these are temporary account. These temporary account tracks financial results for a limited period of time. Limited means normally it's a year, right? So it's a year. So after a year, we say, okay, this year we know how much we've earned. Let's restart for next year. Let's see how much we're making for next year. So you kind of restart it over for next year. But your balance sheet account, in other words, they're permanent account. So permanent account, they tracks from year to year. Remember, in the balance sheet, we always use this as of as your date, right? In the revenue account, we always use this at the accounting period of, always normally at the September 30th. So your balance sheet, they're permanent because they carry the balance year of from a year to years. So accounts, if it's accounts receivable balance $250 at December 30th, 2016. So at the beginning of 2017, 1/1/2017, your accounts receivable balance should start it out as 250, right? So these are permanent account. You should carry year over year. So the closing temporary account, two closing journal entry. You only need two closing journal entries. One is you debit all the revenue account, credit all the expense account, and then you make the difference to retained earning. The next one is that credit dividend declared and debit retained earning. In other words, you want to move this dividend account into the retained earning. For the purpose of this class, I'm just going through. So all you need to know that closing journal entry is just to close out all the income statement account so that you can start refresh for next year. That's all you need to know. So I'm going through these examples just so you have an idea what is it about. So here, all of this, right? You have all of these income statement account. You have all the revenue. Revenue is supposed to have a credit balance, but now I'm debiting it because I want to zero out. All of expense account, you should have normally expense is debiting expense, right? So now I'm crediting because I want to zero out all the expense account. So the difference goes to your retained earning. So you transfer the balance into your retained earning, and then you can zero out this whole income statement account. Same way with dividends, right? Dividends, when you have any dividend, remember when you're calculating your retained earning, you should have a beginning balance plus the net income minus the dividend. So you have to close out the dividend, move out the dividend amount into your retained earning so that your dividend started refresh into the zero balance, right? So after posting these closing entry, all of your income statement account and dividend account should have a zero balance. That's the idea, right? So you're posting all of this temporary account, meaning income statement account, so that you have a refresh start over. Every account should start it with the zero balance. So this is after the closing. Post closing entry, all of your income statement, including the dividend account, should be all zero. And then all of your balance sheet account should be your permanent account, and they carries year to year. Okay, this is the last step in the accounting process. So how the adjustment affect financial statements? Adjustment, again, we said it earlier, helps to making sure that all revenues and expenses are reported in the period in which they are earned and incurred. Basically, it has two concepts here. So revenue, it's according to the revenue recognition principle. Revenue should always recognize when they earned. So if they earned either before they received cash or after they received the cash, we should now record the revenue when they earned. And according to the matching principle, expense should be reported when they incurred in the period in which they are related to the revenue, right? So basically, it's two concepts involved here. One is revenue recognition principle, one is a matching principle. So without adjustment, the accounting financial statements present an incomplete and misleading picture of the company's financial performance. Because without it, your revenue recognition probably wouldn't be complete. They're incomplete because you didn't record all of them. Also, your expense, right, could be mismatching. So that's why the purpose of adjustment is making sure all of revenue should be recognized after they incurred, after they finish their earning process. All of expense should be recorded after they incurred. So that's the whole purpose of adjusted financial statements. So you can go through some of the examples in the slide to help you with the homework. But for the purpose of this class, you don't really need to know the technical accounting journal entries, but just to understand the concepts.